The next thing to have a look at there is the balance of payments account. So you want to put an asterisk beside the definition for us to explain it. This is what we're going to go for. So there's a couple of crucial parts to this, right? The first thing is that it records a country's monetary transactions with the rest of the world over a period of a year. It deals with the inflows and outflows of funds to and from other countries, which is like repeating the same thing in a different way, but get those two sentences in there in explaining it. I suppose a common mistake with explanations of that is people say it's a record of a country's imports and exports, but that's only part of it. We're actually recording the value of those things rather than the quantity of them going back and forth, if that makes sense. So yeah, just in terms of accuracy, it's monetary transactions and it's recording inflows and outflows of other countries. So to explain what they are, yes, inflows are money received as a result of things like exporting, and then outflows are money paid by the country due to us importing from other countries. But it's the flow of money that we're tracking rather than the volume of goods, is what I'm getting at there. So the main elements of Ireland's balance of payments account are as follows. So there's we've got three parts of balance of payments account. We have a current account, a capital account, and a financial account. Now, normally, for the most part, when we're talking about the balance of payments, people are referring to the current account, right? But what's in that box is important because exam questions can ask you about the current account, or it could ask you about the balance of payments account as a whole. So if you just read this box with me, right? It says here, when answering exam questions on the balance of payments, be sure to pay close attention to and establish if you're being asked about the balance of payments overall or just the current account. So if you look at question one here, these are both previous Leaving Cert questions, right? Question one says, describe the main elements of Ireland's balance of payments account. So there you have to focus on all three of these. You've got to go into current, capital, and financial. But part two here says, explain the balance of payments current account. So the current account has four elements in its own right. So let's say for here, with question one, if you only focus on the current account, went into detail there, you'd lose the marks for not explaining capital and financial. Here, if you just focused on, and here, if you focused on the capital and financial account, but didn't go into detail on the current account, you lose marks for it. So just that little bit of attention to detail, something to be careful of. So we're going to look at the components of the balance of payments account. So we're going to start there with the current account, right? So the current account kind of has four parts to it, right? And this is the one that we're generally thinking about when we refer to the balance of payments. So first part on the current account is visible exports plus visible imports. So that's the trade in goods. So an export is obviously something that a visible export is a good that we sell to another country, money flows into Ireland. A visible import is a good that we buy from another country, money flows out of Ireland. So that's the first flow of money that goes into the current account. The next one is invisible exports. So that's similar, but we're dealing with services. So an invisible export is a service that we sell to another country. So tourism, foreign people come to Ireland, they go on holiday, and they spend money in restaurants, hotels, their services. So that would be an example of an invisible export. An invisible import, services that we buy from other countries, money leaves Ireland. So an Irish person going on holiday in Paris, they're spending money over there, the money leaves Ireland, the services they're buying. Then two more, net factor income from abroad and net current transfers from abroad. So let's have a little look at part A there, visible exports plus visible imports. So straightforward enough. The current account visible balance is the most publicly discussed component. So this is like, even within the current account, I said the current account is the most widely talked about part of the whole balance of payments, but even within the current account, we generally talk about the balance of visible trade is the one that's mostly referred to, right? So the current account visible balance, it's the most widely discussed component. If exports are greater than imports, we have a surplus. If visible exports are greater than visible imports, you have a surplus on the visible balance. If exports are less than imports, you have a deficit, and if they're equal, you have a balance. So you have the definition there, so make sure that you can explain both of those things, visible exports and visible imports. So if you look at visible exports there, crucial thing is visible, you associate with the word goods. So visible exports, well, they're goods manufactured in a country and exported abroad. So Ireland's main exported goods include pharmaceuticals. So a lot of us think like our main exports are things like dairy or agricultural produce, but actually it's pharmaceuticals. And then visible imports, a crucial thing, they're goods that are manufactured in other countries and they're imported in here. So we would include things like we would import things like petrol cars, machinery. So the balance of trade then is that visible balance. So balance of trade is that visible balance. It's visible exports minus visible imports, and we call that the balance of trade. We call that the balance of trade. So there's an example there, very straightforward. Assume that in a given year, Ireland exported goods worth of 120 billion to other countries and imported goods worth of 140. So see the way we're only dealing with goods there. So goods and goods, we're only dealing with visible trade. We're only dealing with the balance of trade. So there are exports. Well, we received 120 billion from exporting abroad and we spent 140 billion on other countries' goods. So our balance of trade then, the difference between our visible exports and visible imports, well, we have visible exports of 120 minus visible imports of 140 leads to a balance of trade of minus 20 billion. We have a deficit there. Means that the money outflows, the money leaving Ireland is greater than the money flowing into Ireland. So that's the first part. It is the balance of trade. Next part then on the current account, part B, is invisible exports and invisible imports. So this is very similar, but we're just focusing on services here. So make sure that you can explain them. Invisible exports, well, these are services sold to other countries. So if an Irish band performed abroad, money would flow into Ireland. So U2 perform a show in London, that money flows into Ireland because their bank accounts are hopefully here. But yeah, money, you get the idea, money flows into Ireland. Invisible imports are services that we buy from other countries. So if a foreign band played a gig in Dublin, Taylor Swift came here, that would be an invisible import. So we're buying it, it's a service and money flows out of Ireland, right? Other examples are financial services, banking, insurance, even movies, they could all be included in the balance of invisible trade. So here what we're going to do is we're going to put them together, those first two bits. We're going to look at the balance of trade, sort of visible stuff, and then we're also going to tag on the invisible stuff here to look at the overall flow of money from buying and selling stuff, right? So assume that in a given year, and this is exactly the question in 2024 Leaving Cert paper where you were given an infograph that gave 4 figures. The 4 figures were visible exports, visible imports, invisible exports, invisible imports, and you to calculate the balance, right? So this is what we're going to do in this little box here. We're dealing with that exam question exactly. So if you're looking at this, it says in a given year, visible exports are 100 billion and invisible exports are 80 billion. So these are the goods, the money that we've received from selling goods abroad, and this is the money we've received from selling services abroad. So I'm going to highlight them in green there. Then I'm going to highlight the others in a different color, because those green ones, their money flowing into Ireland, they're good, right? Actually, maybe red's a better color to use. So the other ones there, we're talking about visible imports. So they're goods that we have bought from other countries. So money flows out of Ireland. Highlight that in regs is obviously not good. We should know, going back to national income, that imports are a leakage from the circular flow. They reduce aggregate demand. Invisible imports then, services that we bought from other countries, are 70 billion. So to calculate our overall trade balance, we need to combine both of them. So let's find out what our total exports are there. Well, we've exports of goods of 100 and services of 80. So that's a total of 180. 180 is has flowed into Ireland from us selling stuff to people abroad, basically. Then let's look at the total imports. So we know that visible imports area imported goods of 120, and we've imported 70 billion worth of services. Combine them, that's 190. So the total balance then, we've got total imports worth 180 flown into the country. We've total exports of 180 flown into the country, and we've total imports of 190. So 180 minus 190 would mean that we have a trade deficit of 10 billion because our total imports are 10 billion greater than our total exports. So we would have a deficit there. We would have a deficit of 10 billion. Next part on it then is net factor income from abroad, and this is one that hopefully we should be familiar with again from having studied national income. So this is just the difference between the income earned by Irish-owned factors of production and sent home, and income earned by foreign-owned factors of production operating in Ireland and sent abroad. Remember, it's always a negative in Ireland. So net factor income from abroad is always a negative. So when we say here, like it says, it's the difference between the income earned by Irish-owned factors of production and sent home, and the income earned by foreign owned factors of production here and sent back home. Really, like, we're talking about three flows of money. So we're talking about the profits earned by international companies here compared to and sent back to their home country versus the profits earned by Irish companies abroad and sent back to Ireland. So the profits that those big international companies here earn and sent back home is far greater than any Irish companies earn abroad and sent back to Ireland. Next thing then is the repatriation of wages. So we have more foreign people working in Ireland to send their wages back home than we have Irish people abroad to send wages back to Ireland. And the last thing is to do with loan interest. So we owe other countries more interest from having borrowed money from them, essentially, than they owe us from having borrowed money from us, essentially. So the three outflows that make up net factor income abroad are greater than three inflows. Not a massive deal. You could be asked about that in the context of a national income question. There is a video there on the platform about that. Go and look at it if that doesn't make total sense to you. Just reminding you of it there, right? But it's important to explain. It's just a difference between those two flows. And that box there gives you a sense of, just gives you a practical example of that. But I want to come down to net factor income from abroad, which is the last piece here. Or net transfers from abroad, I should say. So net transfers from abroad. This is nice and straightforward. Really what we're talking about here is we're talking about subsidies received from the EU and taxes payable to the EU. So also payments under third world aid programs operated by NGOs are also included here. So that would be an outflow there. That would be an outflow. So if we're putting it all together there, right, we're going to put all of that together to calculate our current account balance. Putting all of it together. And like this is, like I said, the exam question that was asked last in 2024, you didn't have to combine all four elements. You only asked about steps 1 and 2 there, but we're going to put it all together here so you're totally covered, right? So the first thing is, if you're calculating the overall balance of payment situation, you got your visible exports minus your visible imports, and that will tell us about our balance of trade goods. Then if we want to tag on, if we want to find out the total balance of imports versus exports, we would tag on invisible exports and invisible imports, and that would tell us. So we get total exports minus total imports. That's what we just did a second ago, right? Then net factor income from abroad, we would look at total inflows of money minus total outflows of money. The outflows will always be greater than the inflows. And then the last thing is we look at net transfers. So we would have subsidies received from the EU, and we measure that against those two things that we're paying to the EU and other countries. So taxes and then any Irish aid sent abroad. So if you just look at the next page there, we have a good example of the whole thing in action, right? So we start off and we have visible exports minus visible imports. So that's the trade in goods. So let's say we have visible exports of 72 and we have visible imports of 31, and then our balance of trade then is 41. That's the difference between those two. And in terms of services and the invisible balance, well, we have exported services worth 83 billion, and we've bought services from other countries worth 98 billion. So 83 minus 98, our invisible balance there would be minus 15, because 98 is 15 greater than 83, so minus 15. We've minus 15. Next thing we would look at then is net factor income from abroad. That will always be a negative figure, so that's minus 22 in this case. The net current transfers then will also nearly always be a negative figure. So net current transfers, subsidies from the EU minus taxes paid to the EU and aid that we send to other countries. So that's minus 1.427. So here we have, just tidying it all up, we have that 41 minus that 15 minus that 22 minus that 1.427. And overall then we have a current account surplus of 1506. So that's how it goes. Now, if you just flick over to the next page there, if you're asked to explain the current account, this is the definition that you would need. So if you're asked to explain the current account, so they're the components within it. But if you're in an exam and you're explaining the current account, that is what you're going to go for. So that is an important definition. So it is the sum of trade. So the sum of trade. So we're dealing with total exports less imports, net factor income from abroad, and net current transfers. So the kind of four parts. We said when it's the sum of trade, we're kind of putting visible and invisible together there, right? So the current account is the sum of the trade balance, so exports less imports, net factor income abroad, and net current transfers. Crucially, it records visible and invisible trade over a period of time. It's the difference between total exports and total imports. So it is the sum of the trade balance, exports less imports, net factor income abroad, and net current transfers. It records both visible and invisible trade over time and tells us about the total situation in terms of flows of money from our exports versus our imports.